All right, so in this problem, Cruise and Hamburger's doing well. They're thinking about expanding and adding more booths and an AI kiosk. After receiving bids from general contracts, they estimate the cost to be about $375,000. Depreciated straight lined and no salvage for 10 years. They'll need more working capital at 20,000. Revenue should increase by 55,000 per year. Expenses will increase by 22,000 per year. They want to liquidate and stop working in 5 years. This should increase the selling price by $300,000. The marginal tax rate is 30%, and the required rate of return is 11%. So trying to figure out if they should they sell out and retire. So the purchase price for this is that $375,000 that cost. They require more working capital, 20,000. So I add those two together to get me um, negative 395,000, which then I'll carry down here, and then no changes for this piece. Looking at the cash flows in the medium term, we've got sales of 55,000, expenses of 22,000, a marginal tax rate of 30%, and then depreciation. This is going to be the 375,000 divided by 10 since it's a 10-year project. And then here, calculating those cash flows, that's equal to D16 minus D17. So the net sales times 1 minus the tax rate, so 70% of that. And then I add back the value of the tax shield, that's depreciation times tax. So that's going to be 34,350 for every year. And then for these, I just equaled the previous, highlight that, and send that across. So those cash flows are the same. Last step here before we see if the project is worthy or not of doing this, we then know that we're going to basically sell out of this at 300,000. We'll get back 20,000 in working capital, but now we're going to figure out our tax situation. So in this particular problem, we would take the value of the original project, 375,000, minus the sum of all the depreciation for 5 years, because it's got 5 years left to go. Then minus what I sell it for, the H27 is 300,000. And then I multiply that by age 18, which is the tax rate. So I'd have to pay $33,750 on my capital gain. This yields for this particular part of terminal cash flow 286,250. And then I add that to the previous 34,350 to get the final terminal cash flow in year 5. So these are my listed cash flows as you see there from C37 to H37. I'll now calculate the NPV and IRR. If the discount rate's 11%, net present value is equal to the 11%, comma, and then I highlight the year 1 through 5 total cash flows, operating cash flows after tax. And then I add back to that the initial cash flow cost in cell C37 of 395,000. So if I were to use NPV to make this decision, I would say this is a bad play. And then the IRR, calculating it, just highlight all the cash flows using the IRR function. And again, we see this is less than 11%. So if I'm using IRR to make my decision, I would reject the project using that criteria as well.